From the war in Ukraine to ongoing tensions in the Middle East, from interest rates to inflation, from AI to electric vehicles, from elections to climate change. These are the forces that will shape tomorrow's stock market. What is really happening in the world around us? How do these events affect your portfolio? And what can we expect next? Let's analyze each of them, one by one. War in Ukraine. It's been 438 days since Russia launched its attack on Ukraine. As of today, more than 750,000 people have fled Ukraine, while millions more have been displaced within the country. Millions of homes have been destroyed, thousands of businesses have been forced to shut down, and entire communities have been decimated. But what does all this mean for investors? When conflicts like the war in Ukraine erupt, they can cause significant disruptions to global markets, including the stock market. For example, the war has led to increased energy prices, especially for oil and natural gas, which has contributed to higher inflation and economic uncertainty.
There is no clear path to peace at this moment, and the conflict could drag on for months or even years. The longer the war goes on, the greater the likelihood that it will have a negative impact on the economy and the stock market. However, some sectors may benefit from the war. For example, the defense and aerospace industry may see an increase in demand for their products as countries increase their military spending. Similarly, the energy sector may benefit from higher energy prices. Tensions in the Middle East. Tensions have escalated in the Middle East following Israel's military operation in Gaza. While the full implications for the stock market remain uncertain, history suggests several potential outcomes. In times of geopolitical uncertainty, investors often seek safety in U.S. Treasuries, driving up their prices and lowering yields. In contrast, other assets, like stocks, tend to fall as investors assess the risks. Historically, periods of high geopolitical uncertainty have coincided with lower corporate profit margins due to increased costs associated with doing business in a volatile environment. Looking ahead, several factors will influence the stock market's reaction to tensions in the Middle East. A broader regional conflict would likely send shockwaves through the global economy, increasing market volatility and potentially triggering a sell-off. On the other hand, if tensions remain localized and de-escalate, the stock market may experience only a minor pullback before resuming its upward trajectory. Central bank decisions. Central banks play a crucial role in regulating the financial system and controlling inflation, which directly affects the stock market. When central banks raise interest rates, borrowing becomes more expensive, which can lead to a decrease in consumer spending and corporate investment, ultimately affecting stock prices. High interest rates can also lead to a stronger currency, making it more difficult for companies to compete in global markets. Conversely, when central banks lower interest rates, borrowing becomes cheaper, stimulating economic activity and potentially boosting stock prices. For example, the Federal Reserve's decision to lower interest rates during the COVID-19 pandemic helped to stabilize the stock market and prevent an even greater decline. Similarly, the European Central Bank's recent rate hike aimed at curbing inflation may impact the region's stock market performance. By staying informed about central bank policies and their potential impact on the economy and specific industries, investors can make more informed decisions and adapt their portfolios accordingly. Inflation. Inflation is a general increase in the prices of goods and services in an economy over a period of time. When prices rise, each unit of currency buys fewer goods and services. Consequently, inflation reflects a reduction in the purchasing power per unit of money. When inflation is high, as was the case in 2022, it means that the value of your savings and investments is eroding more rapidly. This can discourage investing and spending, which can lead to a decrease in economic activity and a potential recession. Central banks often work to keep inflation at a moderate level, typically around 2%, to ensure economic stability. However, recent events such as supply chain disruptions and the war in Ukraine have contributed to higher inflation rates, presenting challenges for central banks and policymakers. To mitigate these effects, central banks have been raising interest rates to try to slow down economic activity and bring down inflation. However, there is a risk that these measures could also contribute to a recession. Investors should monitor inflation levels and central bank policies closely, as they can significantly impact stock market performance and overall economic conditions. Technological advancements. Technological advancements such as artificial intelligence and electric vehicles are transforming entire industries and creating new investment opportunities. For example, companies that develop AI-powered software or electric vehicle batteries are likely to see increased demand for their products. In contrast, traditional companies that fail to keep up with these advancements may struggle to compete and generate profits. As a result, investors need to be aware of these changes and consider investing in companies that are well-positioned to take advantage of new technologies. One way to identify these companies is to look for those that are investing heavily in research and development, as this is often a good indicator of a company's commitment to innovation. Additionally, investors may want to focus on companies that operate in industries that are being disrupted by new technologies, as these companies are likely to be at the forefront of developing new products and services. Furthermore, it's essential to keep up with the latest developments in technology and to invest in companies that are well-positioned to capitalize on emerging trends. Overall, technological advancements are reshaping the stock market, and investors who embrace these changes and invest accordingly stand to reap significant rewards. Economic data. Economic data provides valuable insights into the overall health of an economy and can help investors make informed decisions about where to allocate their money. One key indicator is GDP, which measures the total value of goods and services produced in an economy. A growing GDP indicates a strong economy, while a decline in GDP can suggest a recession. Another important indicator is employment data, which can provide insights into the strength of the labor market. When more people are employed, it typically signals a healthier economy and greater consumer confidence. Consumer confidence is also a vital indicator, as it reflects how optimistic or pessimistic consumers are about the economy. High consumer confidence often leads to increased spending, which can drive economic growth. By monitoring these and other economic data points, investors can gain a better understanding of the current state of the economy and make more informed investment decisions. Elections. Elections can have a significant impact on the stock market, as they often lead to changes in government policies and regulations, which can affect the profitability and growth prospects of companies. For example, changes in tax policy, trade policy, or environmental regulations can all impact the cost of doing business and the overall competitiveness of companies in different industries. Additionally, elections can also lead to changes in leadership and government stability, which can create uncertainty and volatility in the stock market. Investors often try to anticipate the outcome of elections and adjust their portfolios accordingly, which can lead to fluctuations in stock prices. Political instability can significantly impact the stock market by creating uncertainty and risk for businesses, leading to decreased consumer confidence and reduced investment. For example, changes in government policies, trade wars, or geopolitical conflicts can disrupt supply chains and increase the cost of doing business, which can negatively affect a company's bottom line. Additionally, political instability can lead to social unrest or violence, which can damage property and infrastructure and further erode investor confidence. During times of political instability, investors often seek safer investments, such as government bonds, which can push stock prices down. Moreover, political instability can also lead to changes in leadership and government regulations, which can create uncertainty and volatility in the stock market. Companies that rely on government contracts or operate in highly regulated industries are particularly vulnerable to changes in the political landscape. To mitigate the risks associated with political instability, investors should consider diversifying their portfolios across different asset classes and industries, and staying informed about current events and their potential impact on the stock market. These factors can all affect the profitability and growth prospects of companies, particularly those in industries that are heavily impacted by climate change, such as insurance, agriculture, and energy. Moreover, governments and regulatory bodies are taking steps to address climate change, such as implementing carbon taxes or setting emissions reduction targets. These policies can create both challenges and opportunities for companies, as they need to adapt to the changing regulatory environment while also finding ways to reduce their environmental impact. Investors who consider these factors and prioritize companies that are taking action to address climate change are likely to be better positioned for the future. So what should you do? The best approach is to stay informed, diversify your portfolio, and invest for the long term. It's important to remember that short-term fluctuations in the stock market are normal, and that a well-diversified portfolio can help mitigate risks. By staying informed about current events and their potential impact on the stock market, you can make more informed decisions about your investments. Consider diversifying your portfolio across different asset classes and industries to reduce your exposure to any particular risk. And focus on investing in companies that have strong fundamentals and a history of profitability and growth. Keep in mind that investing always involves risks, and past performance is not indicative of future results. Don't let short-term market fluctuations dictate your investment strategy, and always consult with a financial advisor before making any investment decisions. Stay updated with the latest news and analysis, and be prepared to adapt your portfolio as needed. By following these tips, you can navigate the complexities of the stock market and position yourself for long-term success.